Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, you told me just before we went live, there's only 4 trading days this week.
I know, but it's a lot going to be packed into these 4 days.
Jam-packed. So let's get to the biggest stories right now in the nearly $19 trillion global ETF industry. And we start, with the 2-year Treasury yield falling as Fed Chair Jerome Powell says that longer-term inflation expectations appear to be in check as the central bank assesses the war in the Middle East.
Plus, with the war in Iran entering its 2nd month, we speak to Stephen Schoenfeld of MarketVector Indexes on the performance of Israeli equity ETFs.
And Katie Wheeler, great name, she's from Ondo. She discusses its partnership with Franklin Templeton to tokenize ETFs. All of that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now, and he's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. So we're looking at the flows. There's been some rebalancing going on. So we're going to look at the 1 month, right? The week is going to have a lot of flows that are more heartbeat trades and not sentiment. But for the month, we can see a lot more sentiment. So SPY-M, by the way, this is interesting. This is the S&P 500, the SPY, you know, the famous ETF. It's kind of its mini-me. It's actually just crossed $100 billion. It is growing very quickly. Why is it so popular? It's only 2 basis points, and IVV and VU are 3. So it's the cheapest S&P on the market, and it's working. SGov is Treasuries. There's IVV, again, more S&P. Bill is Treasuries. GOVT is Treasuries. Now, I rarely see 3 Treasuries that high in the list. This tells me that this Iran situation and the stock market sell-off is making investors nervous. They're reaching for safety. More on that in a minute. Let's look at the outflows here. And you can see it's nothing too wild. I mean, this money, I believe, is somewhat tax-related. But VU had like $55 billion. Now it's down to about 40. And we're going to have to see how much of that is tax. We got to wait a couple weeks to see how this plays out. It's still number 1 in flows with SPYM right there. OEF, GLD, outflows, that's interesting. Gold has not really worked since the Iran strike, and some people are leaving gold. So that's $11 billion out of gold and some out of the Qs. So again, mostly bearish, honestly, for this month. Let's look at the treasuries. And I was like, wow, you know, these treasury ETFs at the top of the leaderboard, let's look at the monthly flows historically. And I'm not surprised this chart looks like the way it does, because almost $30 billion into treasury ETFs. Look at how much of a jump that is over last month and just average, right? So this, to me, is the first sign, again, in probably a year and a half of real fear, Katie, where people are running into treasuries and money market mutual funds.
Eric, thank you. Let's keep this conversation going with Todd Rosenbluth. He is head of research over at TMX VettaFI, joining us on set. It's great to see you, Todd.
Great to be here.
So let's start there. This renewed appetite for bonds, which I find interesting because prior to today, we've seen a big sell-off. We've seen yield spike. But, I mean, as Eric highlights, you do see this sort of revived interest in particularly the front end of the curve.
Yeah, so it's easier to be safe and then ask questions later. And so I think that's what investors are doing. So we saw Bill, we saw SGov be very popular this month. We've seen investors turn towards fixed income ETFs for their capital preservation. We've seen investors turn to some of those options-based income strategies that you were talking about on stage at Exchange, where people are looking for income and some stability and safety. So there's an ETF for just about everything. And for people who want to be more risk off, we've got that.
Before the war in Iran began, of course, AI was the only thing everyone talked about, and the only way that people were seeking some kind of extraordinary growth going forward. AI seems to be dipping in terms of just taking up everyone's mind space, but we're now looking at thematic ETFs beyond AI, particularly among defense companies.
You're right. So we saw Global X's Shield, SHLD, be very popular this year. We've seen the Rex Drones ETF, DRNZ, gain some traction and from performance. We've seen AI be a bit more adjacent, so nuclear energy. I know Eric has talked about nuclear energy for years. I remember back in the day at conferences where he was singing the praises for it. NUKZ, which is a range nuclear renaissance ETF.
It's too early to
very
troll.
popular.
Yeah,
No.
Wait till about 4 minutes have gone by in the segment.
You were right. It's been a very popular way of investing to get exposure towards companies tied to AI, but not necessarily in the technology sector.
I appreciate you saying that, by the way. In 2020, all the analysts had to pitch best new ETF of the year. I picked uranium. Since then, it's up like 500%. I was right. I came in like 4th place, though. And I I'm not bitter, don't worry.
It's not a sore subject at all.
Anyway, that was the biggest Rob job of all time, I think. Anyway, let's move on.
You didn't win.
Yes.
Unbelievable.
Okay, let's talk about this article you wrote recently about indexes. I write this all the time. People think indexes are like static, right? They hold the stocks, and in a way they are right now, but they're always changing. And you go over many examples. I always use the S&P. NVIDIA 5-6 years ago was like the 100th stock. Now it's like 1 or 2 or whatever. And why does that happen? Active is making these choices. So active sets the weights. The index merely copies what active does. Am I right? You want to talk about that a little bit?
So you're referring to market cap weighted strategies like the S&P 500, where the rebalance happens almost never. A stock will move in and the stock will move out when something drops far enough out or it gets acquired. But there are indices that are getting rebalanced on a quarterly basis. S&P does it. FTSE Russell does it from time to time. We at VettaFi are an index provider behind free cash flow ETFs from Victory, for example. And S-Flow just went through a rebalance. It added many small cap companies that meet the free cash flow growth characteristics and removed companies that no longer do. In thematic ETFs, there's an ETF Gamer, GAMR, from Amplify. And what it did was it added a couple of international stocks. This is an ETF that only owns 21 positions. So when something comes in and something comes out, that's a big deal. So people need to pay attention to index-based ETFs. There are changes that happen. It's not exactly like active management, but it's something closer than what people might otherwise expect.
Even behind an index, there are humans, and it's certainly a nice reminder. But this dovetails nicely into some news from this morning coming from Nasdaq, that they're going to put in place a rule change that is designed to slash the time it takes for new IPOs to enter the Nasdaq 100 index. So you think about SpaceX reportedly going public in June. Now, basically, it'll take just 15 days for an IPO to make its way into the Nasdaq 100 if its market cap falls within that of the current constituents. Obviously, this will have read-through into index land, and I wonder, what you think that might be for the Qs, for example.
So I think the Qs and other more market cap weighted like products, Qs is a little bit of a nuance because it doesn't have financial companies. We'll move that to the side for the moment. It wants to be representative of the marketplace and have the largest companies that are listed on the Nasdaq in the case of the Qs. So it makes sense that they want to be representative. SpaceX is likely to be one of those 100 largest companies overall. But that's also going to have an impact when SpaceX becomes public. There's a couple of space ETFs that exist today. The Procure Space ETF UFO is an example of one of those that I would think is likely to add SpaceX over time. So I think we're going to see a renewed interest in thematic ETFs, the way that we were talking about, tied to space when SpaceX comes around.
I'm curious why this didn't happen earlier. Why do this now? I know we have a big year with IPOs, SpaceX, Anthropic, some other names that are coming to market pretty soon. But was it a wise idea to wait until now?
Well, I think there's examples in the past where there are companies that came public that took a while before it got added in. I think the index providers want to be responsive to the marketplace. I'm sure that people raised thoughts and shared thoughts about why something might be in and could move faster. And I think that's a good thing, that the index community is responsive to the investor community.
And before we let you go, I do want to bring up some research that Eric and Andre Yap just put out today, actually, and that's just talking about sort of the lifespan of freshly liquidated ETFs overall. I thought this was fascinating, that the average life of liquidated ETFs in 2026 was about 1 year and 9 months. For context, that's about half the time in 2025. That was 3 years and 6 months, and roughly a third of the time in 2024. So basically, issuers are killing off ETFs faster than they have been, giving them less of a chance to sort of trade and gather assets. And I think that's a really interesting sign of the times, and I would love to hear your thoughts on what you think that says about the current ETF environment.
So they're also launching them faster than they ever did beforehand. We've seen more than 1,000 ETFs that came to market last year. The rules have made it easier to launch an ETF. That's a good thing, but distribution remains king. We had a session at the Exchange Conference on Sunday that talked about how to get your ETF to grow fast enough. You don't want to just build an ETF, but you want to grow that ETF. And so distribution is a key differentiator. So I think asset managers need to take a closer look at how they gather the money that get to that first $100 million, which is a key milestone for survival, instead of just bringing the product to market and hoping that it grows on its own.
Yeah, we think it means there's probably going to be more consolidation because, again, it's less patience, more about the business side. Goldman acquiring Innovator, we think, is another sign. Do you think we'll see more consolidation in the next couple of years?
I do. There are some firms that are having some success that are in some of those sweet spot areas that are tied to covered call strategies, that are tied to leverage products. And I think asset managers that want to skate where the puck is going might want to buy them. We obviously saw Victory try to buy Janus. Janus is more than just an ETF company, but they had a lot of success with CLOs. I think there'll be more consolidation efforts underway.
Yeah, it was certainly fun to see a bidding war in the asset management landscape. Todd, great to get some time with you. That is Todd Rosenbluth of TMX VettaFI. Now, coming up, we speak to Katie Wheeler of Ondo on its partnership with Franklin Templeton to offer tokenized versions of its ETFs. That conversation next. This is ETF IQ. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF world. So let's start with what we're seeing in the commodity space. We know it has been a rough ride for some of those precious metals, including gold. And you're taking a look at GLD shares right now, what we've been seeing in terms of the flow of money. And you can see that March was a big month for outflows, about $8 billion ripped out of GLD. We haven't seen that in quite a long time. We know that gold has been really declining, so we'll see if that pain continues in April. But let's talk a little bit about the funny stuff. You know, you think about leverage, you think about crypto products. They have been all the rage when it comes to new products coming to market. And you can see that so far in 2026, they've made up about 35% of launches. That compares to 36% in 2025, which you can see was a record and then some. We'll see if 2026 will eclipse that, because so far it's well on its way there. But let's end, Scarlett, with this announcement that we got last week from Franklin Templeton, partnering with Ondo to create tokenized versions of some of its own ETFs. Theoretically, this will allow for around-the-clock trading via crypto wallets, actually bypassing brokerages altogether.
All right, so let's talk about this development further with Katie Wheeler. Katie is Managing Director of Partnerships at Ondo. Ondo uses blockchain technology to build financial products. So, Katie, we talked about how there are these 5 ETFs that you've now tokenized. What is the plan? To start with these 5 and then to branch out to all ETFs? How do you measure success here?
Yeah, absolutely. Thanks for having me on. So the last week was very exciting. We announced a partnership at Digital Asset Summit in New York. Franklin Templeton, which is one of the largest asset managers in the world, managing $1.7 trillion in assets. These ETFs are now available to investors in APAC, in Middle East, in Latin America, and in Europe. Tokenization basically allows ETF issuers to access this whole new digitally native global audience with hundreds of millions of investors. Right now, it's just the 5 ETFs, but as a platform, we have 260 assets live today, and we intend to scale that to 1,000 assets by the end of this year.
So, Katie, it's Eric here. I have been debating with the tokenization people for the past couple of years. There's this idea that tokens are going to take over everything. I try to push back on that. I'm like, look, with an ETF, you can roll out of bed, hit a button, and own anything in the world with almost no friction and for almost no fee. It's hard to beat that. However, what you're doing, you're taking the ETF and distributing it to places that don't have it, say people on chain who like to deal in that world, or in less developed countries. But A, how much money is there? And B, are you banking on that world getting bigger and bigger, where it actually supersedes the sort of people who use Schwab as a broker world?
Yeah, absolutely. So for many investors globally, it's not a choice. They can't access these ETFs in a brokerage. And if they do, they have to pay either high fees or there's high minimums. So tokenization really brings ETFs to hundreds of millions of wallet-based investors and adds 24/7 trading and instant settlement. These assets are fully backed, they're bankruptcy remote, and they're permissionless, which also allows you to use them within DeFi, which is creating new utility for these assets. So now a holder could actually borrow against their tokenized SPY or their tokenized Tesla. Stablecoins were really the gateway drug towards this new on-chain economy. And once people get used to holding a dollar-denominated stablecoin in a wallet, the first thing they want is yield. So that's why Ondo started with tokenized treasuries. And then 6 months ago, we launched our tokenized equity and ETF platform.
Right.
We've been seeing tons of demand. We just crossed $700 million in TVL, and the industry itself is at $1 billion. I personally see two big catalysts of growth here, though. The first one is the generational wealth distribution. The baby boomers, that's trillions of dollars that are moving out of these 60/40 portfolios into a more crypto native on-chain hands. And then the second is with AI agents, right? An AI agent can't walk into a bank and open a bank account, but they can manage a crypto wallet. They can auto rebalance all of your assets. And so I think those two catalysts in particular will really grow the pie.
So I do just want to push back a little bit. You know, you mentioned costs. For a lot of these ETFs that we're talking about, they cost maybe 10, 20, certainly under 50 basis points. A lot of the brokerages have free trading. So, you know, you think about the potential savings here. Are you able to quantify, you know, how much exactly an investor would save by using a tokenized ETF, accessing it through a crypto wallet, which I assume you also have to set up and maybe pay a fee for?
Yeah, we're already connected to the largest exchanges like Binance, BitGet, Gate, the largest non-custodial wallets like MetaMask, Phantom. These people are already in stablecoins and they already have wallet infrastructure. So it's very easy for them to go to a stablecoin into these wrappers. And they're getting the same fees that a normal off-chain investor would get. We've run different analysis, and the same amount of slippage you would get off-chain is about the equivalent to what you would get in a Charles Schwab account.
Katie, you had mentioned that these tokenized ETFs, the five that you're launching, will be made available to investors in Asia and outside the U.S. So right now, these are not available in the U.S. My question is, when do you think this offering, tokenized ETFs, will be made available in the U.S.?
We're working with the SEC task force to hopefully have a path forward in the next 9 to 18 months. Right now, the way that we issue our assets is there for non-U.S. investors because we really think that's where the biggest opportunity is. People outside of the United States who haven't been able to participate in U.S. capital markets in the past. However, it's definitely on our roadmap and something I, in particular, as a U.S. investor, definitely wants to see come in the near future.
Katie, thank you so much. Katie Wheeler, Managing Director of Partnerships at Ondo, on their partnership with Franklin Templeton to tokenize ETFs. Now, still ahead, we look into two ProShares ETFs in the Bloomberg Intelligence traffic light system. Eric, these are not green light ETFs, are they?
No, these are hardcore.
All right, we'll have more coming up. This is ETF IQ on Bloomberg.
I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks are mixed with the Nasdaq flipping between gains and losses. If we finish in the green, then we would snap a war-driven sell-off that marked the longest weekly losing streak since 2022. The policy-sensitive two-year Treasury yield is falling as traders scale back bets on an interest rate hike this year and price in the possibility of a cut by the end of 2026. Meanwhile, investors remain fixated on oil markets as they price in growing supply risks with the conflict in the Middle East stretching into a fifth week. And Fed Chair Jerome Powell signaled that the central bank is inclined to look past rising oil prices rather than adjust interest rates in response. Take a listen.
Inflation expectations do appear to be well anchored beyond the short term, but nonetheless, it's something as we will eventually maybe face the question of what to do here. We're not really facing it yet because we don't know what the economic effects will be.
Elsewhere, Fannie Mae and Freddie Mac are soaring after a months-long slide following comments from Pershing Square's Bill Ackman, who called the mortgage finance giants, quote, stupidly cheap. Even with the latest bounce, the stocks remain down about 60% from their mid-September peak. Those are your midday movers. I'm Nora Melinda.
It is time now to take a look at the Bloomberg Intelligence traffic light system, which ranks ETFs by risk level. So green light means low risk, yellow light means moderate risk, and red light means high risk. And Eric, in terms of the ETFs you've chosen today, you've gone with a bright red light ETF.
Yeah, anything that has VIX in the name is a red light instantly. And in this case, UVXY is a sort of famous VIX tracking ETF. Here's why. VIX futures, when you roll them, you tend to pay up every time you roll. So it's almost like holding something that's corroding very quickly. So you got a 6 there. There's actually double leverage, which would have even more, be like a 10. But anyway, the reason I bring this up is people do like to use them to hedge their portfolio in short-term increments. So if you think like the next 2 weeks are going to be like really dangerous for your portfolio, this isn't a bad choice. Because listen, in the month of March, UVXY is up 53%. When it works, it works.
But you wouldn't hold it for that.
You would not
month.
hold it because get this, over the past year, it's down 41%, even though the market's up 10%. So again, if you can treat it like a hot potato and really trade it, it can work wonders. But you got to be real careful. That's why it's got the red light.
So I feel like that's true of a lot of these, daily reset leveraged ETFs. Is it, is that dynamic more exacerbated when it comes to, VIX, or is it just that, the VIX is hard to predict here?
It's totally the VIX. VIX, instant red light, handle with care, whatever you want to say. It's like, pretend it's a chainsaw. That's how you should approach it. Now, SH, this is a 1x inverse. This is only yellow. We determine that if you're just doing inverse, the actual corrosion isn't as bad. So, for example, in March, the market's down 8%. This is up 8%, right? 1 year, the market's up 10%. This is down 5%. So it's pretty consistent medium and long term. So if you're looking to hedge your portfolio over a year, this one would be way better. Again, still yellow. Diversification is great, but these days, not everything is diversifying. So I think these two are actually have some merit, given the lack of, bonds don't really work anymore. Gold isn't working. So I think people are looking at these, but those would be the difference between those two.
You'd have to pay up, though. I'm looking at SH, and the expense ratio is 89 basis points.
Yeah, so if you hold it over a year, that's costly. But if you save 5% or 10% in decline of the portfolio, it makes it worth it. But certainly, that's why anything with leverage, you're going to find high fees. But if you trade it, the fee isn't as important. If you're in there for a month, that's a prorated number. So it's probably only like 8 basis points.
Just quickly, I'm taking a look at the flows. It seems like even with that crazy month that UVXY had, not necessarily seeing a lot of investors come and bite. I guess they've been burned before.
Because this is so whacked out area that people, as soon as it goes up, they sell. And as soon as it goes down, they buy it again. It's a whole scene over here. It doesn't make any sense. It's like the upside down world when you go into the VIX area.
A whole scene.
Yeah.
That's how I described this show as well. Eric, thank you. You can look at the traffic light system on your terminal at BI ETF Go. Now, coming up, we drill down into Israeli ETFs with Stephen Schoenfeld. He is CEO of MarketVector Indexes. That conversation coming up next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Scarlett Fu. Let's get to the ETF life cycle, where we walk you through the 3 main stages of the ETFs, from initial filings to final farewell. Now, step 1 is the filing. Paperwork for a T-Rex 2 times long Anduril daily target ETF is in, despite the fact that Anduril, which is a defense tech startup, is not publicly traded and has not yet announced an IPO. So this ends up being a bit of a placeholder filing without a proposed ticker. Step 2 is the launch. Vanguard has 10 target maturity corporate bond ETFs that began trading last week. The maturities are targeted for each year from 2027 through 2036. Their tickers range from VBCA through VBCJ. And for some, the final stage is farewell. Say goodbye to STXM and STXI. This is a pair of passive funds targeting mid-cap stocks in international developed markets, respectively. For STXM, assets peaked at around $23 million. Their issuer Strive has since leaned into crypto and being a Bitcoin treasury company. And that is your life cycle.
Meanwhile, on last week's life cycle, we mentioned Alpha Architect offering a newly formed ETF in what's called a 351 exchange. Joining us now is Brent Sullivan. He is a tax analyst over at Tax Alpha Insider. Brent, great to have you with us. 351's so hot right now. Maybe you could just give us the quick, 30 to 45 second explanation of what exactly they are and why we're seeing such an uptick here.
Yeah, so Section 351 is pretty much a century-old M&A law that allows seeding new corporations with existing appreciated assets. And the whole idea was that Congress did not want tax friction between the initial appreciated assets and funding a whole new corporation. And I think since 2019, what's happened is that the ETF industry has started adopting this for their own uses. And so 2019, that was custom basket relief from the SEC. Since then, we've had a whole progression of white label providers make this super easy to launch ETFs and now toggle on the 351 in-kind option. And then word is just getting out, assets have appreciated. And so it's just a popular rebalancing mechanism.
Is this a tool that's just for the wealthiest investors?
No, I mean, what I'm seeing is contributions down to something like $100,000 or $200,000, and they're working through their advisors. Their advisors are making the ACAT transfers such that individual investors are taking advantage of this.
Brett, so I want to look at some of the biggest ones that we've seen come to market. Eagle Capital, Sequoia, Brown, Scharf. These are all above $500 million, so pretty big. Meb Faber, I think he kicked it off about a year and a half ago. But this has now turned into a pretty big situation. How much in assets would you estimate we have seen now? And do you think we're going to see more? And then let me add a little end to that, which is, do you think the IRS will look at this at all?
Mm-hmm.
You know, going back to 2021, I see something like 77 individual ETFs seeded in kind by individual investors. And that's something like $16+ billion in launch assets. So yeah, it's accelerating. You know, starting in 2024, I think with Meb Faber's public appeal, that's really what was new about this. 2025, it accelerated with even more funds and assets. 2026, we're seeing, I think we're going to surpass 2025 pretty comfortably, maybe by the middle of the year. So yes, this is still accelerating in a serious way. Is IRS going to take a closer look? Yes, if there is really aggressive behavior out there, I think it's a good thing that they're taking a look at some of the transactions that are maybe subject and or suspect and could be worth another set of eyes, so that the rest of the industry can still really enjoy routine transactions here.
Well, to that point, actually, Bloomberg News did report at the end of February that the U.S. Treasury Department is in early discussions about increasing scrutiny on 351s, basically considering labeling such conversions as, quote, transaction of interest, which is a designation for deals that the IRS and Treasury see as having tax avoidance potential. So you mentioned, you know, if we do see maybe some really high-profile examples or some questionable cases, maybe that scrutiny increases. And with that in mind, I mean, you think that the wealthy investors that are kind of behind some of these 351s are basically going to become more quiet about what they're doing here?
Yeah, I mean, the ETF is a very public vehicle, as we all know, and that's one of its huge attributes, is that everything is out in the open, more or less. And so what does that mean? Well, maybe investors who are trying to achieve tax-free diversification, which is what Congress is really trying to prevent, maybe investors who are doing that don't use such a public vehicle. And I think that's one thing I'll see. And then another thing is that maybe Congress passes new law. I mean, it's possible. The next thing is that regulation could change. We could get clarity on some of the gray spots in Section 351 specifically. And enforcement guidance could change too. So those are the things that I'm paying attention to.
What can you not do with this 351 conversion, this 351 structure? Could you just put one stock that has done super well? Let's say you invested in NVIDIA from the beginning and you wanted to sell it. Could you put that into a 351?
The short answer is no. Section 351 has got these diversification rules, the 25% and 50% rules. And just really quickly, just make sure that you cannot achieve tax-free diversification. That was Congress's original intent. Again, talk to your tax attorney about the specifics here, but that's really what they were trying to prevent. And the famous quote here is tax-free diversification is the perceived evil that Congress is trying to prevent. And so just don't do that kind of stuff, and then everything tends to be above board, but you must be already diversified to make that contribution.
So, Brett, you've written about direct indexing. Again, that's when you basically try to copy index on your own with your advisor and you buy all the stocks and then they do tax loss harvesting. It seems like these are kind of like stealing the thunder from direct indexing, which honestly never got going. Can you talk about the difference between those two avenues?
Yeah, totally. So, I mean, actually what I'm seeing, Eric, is that a lot of folks will take an appreciated direct indexing portfolio. Maybe they've squeezed all the tax loss harvesting juice out of it, and now they're taking that entire appreciated portfolio and they're contributing it back to the ETF wrapper. And so that's really what I'm seeing there. And you're right on total assets. What do we have in direct indexing now? Maybe $1 trillion all told. ETFs growing faster, even though it's a much bigger asset base. So I'm with you.
All right, Brent, thank you so much. A really fascinating part of the ETF landscape here, talking about the Section 351, not necessarily to skirt taxes, but it's a way of...
Tax alpha.
Yeah,
tax alpha.
efficiency. How about that?
There you go.
Brent Sullivan of Tax Alpha Advisor. And a reminder that you can listen to Eric Balchunas and Joel Weber on Trillions, their podcast that covers the entire industry. Joel will actually be joining us at the end of the hour for our IQ test. And I forget who's ahead.
It's not you, it's not me, so.
I know. Well,
No.
I know who's behind.
I'm slipping, though.
Yeah.
Yeah, you
I'm
did.
vulnerable.
You did lose 1 or 2 questions
We're
last
all
week.
backtracking.
This is ETF IQ on Bloomberg.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks are mixed with the Nasdaq flipping between gains and losses. If we finish in the green, then we would snap a war-driven sell-off that marked the longest weekly losing streak since 2022. The policy-sensitive 2-year Treasury yield is falling as traders scale back bets on an interest rate hike this year and price in the possibility of a cut by the end of 2026. Meanwhile, investors remain fixated on oil markets as they price in growing supply risks with the conflict in the Middle East stretching into a 5th week. Fed Chair Jay Powell signaled the central bank is inclined to look past rising oil prices rather than adjust interest rates in response. In corporate news, Boston Scientific shares are tumbling to their lowest intraday level since January 2024 after results from a trial of its Watchman heart implant fell short of investor expectations. Leerink Partners says that data is, quote, not the home run scenario polls were hoping for. And finally, Cisco was plunging on pace for its biggest drop in 6 years after the food supplier agreed to buy Jetro Restaurant Depot for roughly $29 billion, including debt, in a deal that would create one of the largest food service groups in the United States. Those are your midday movers. I'm Nora Melinda.
This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, today we have a very timely ETF, ITEC or ITEQ. It's the Amplify Blue Star Israel Technology ETF, one of the few things up in March since the Iran strike. So this is a classic sort of country thematic ETF. It's passive, so it does track an index, the Blue Star Index. And what does it look for? It looks for companies that are in Israel, that are in the tech space, but it could be not just like software, but things like clean energy, biotech, medical devices. Let's look at the holdings here, and you're going to see a lot of companies that you probably haven't heard of. And that's probably good. Like if you're going to buy sort of a satellite position, I like that I don't know a lot of the companies in here, but they come from the semiconductor world. There's some aerospace, like I said, medical devices, biotech, and then straight software. Let's look at the performance. So I'm going to look at the past month because I think this is when this thing kind of came into play here. And you can see since the Iran strike, it is up, not a ton, but it is up. But look, everything else is down. And the other things I have in there are IFA, that's international. This is the iShares Israel ETF. So the tech is actually up even though Israel, the country, is down, and SPY. However, it is lagging some of these when you go out to 5 years. So we'll see if this sort of recent bump can help it gather more than the 100 million in assets it has, Katie.
All right, Eric, thank you. Joining us to talk about this ETF, I'm pleased to say, is Stephen Schoenfeld. He is CEO of MarketVector Indexes. Great to have you in person with us. So I think it's interesting. A lot of people, I don't think, would have guessed that ITEC would have outperformed in March necessarily. But as Eric walked us through, that was certainly the case. So just give us a little bit of an explanation there. I mean, why was March so good for Israeli equities?
So March was not the first time that ITEC rallied when other markets fell. Last summer, when the first phase of the Iran-Israel war, which the U.S. joined at the end, ITEC also rallied. What ITEC is reflecting is the removal of an existential threat on Israel's economy and on Israel. And the Israeli tech companies that are leading Israel's innovation are in iTech. So Eric mentioned technology, but you also have defense tech. The biggest holding is Elbit, which not only supplies Israel's military, but is growing enormously in the defense boom in Europe and the US. It has subsidiaries in the US. Cybersecurity, area security, unmanned vehicles, land, underwater, and air. All of these are in iTech. And so iTech has been subdued because of the war, and now people are seeing value.
To what extent does the current war, the conflict right now, disrupt businesses for these companies, though?
So this has been a perennial question for Israel. And one of the most amazing things about Israel is how resilient the business sector is. They've grown up with war. Many of the founders were in the technology arms of the IDF. They're pretty used to like being in a conference call or on a Zoom and then going to the shelter and coming back. And so even during the worst parts of Israel's battle with Hamas, these companies not only kept growing, but they're raising capital. We just got the numbers for Q1, $3 billion of new money going into Israeli tech startups.
And I want to go back to the 5-year performance, because it is interesting. iTech has been lagging Israel, the country, but just it's interesting they're so different. And EIS, which is this sort of Israel ETF from iShares, has a lot of banks. Why were banks doing so well and tech not, given tech does well everywhere else?
So both EIS and ISRA from VanEck, which tracks another one of our indexes, think of them as the S&P 500 of Israel. So they include banks, retail, industrial, which you wouldn't think would do well during the crisis. But during the crisis, the Israeli shekel appreciated, so those companies are more connected to the shekel. The banks have done well because Israel's economy has continued to do well. So if you think about the early part of this war, all of Israel has done well. We believe that now Israel tech is poised to shine.
And so who is the intended, or you think the natural audience for ETFs such as this? I mean, is this just self-directed retail? Are you pitching to advisors as well? And I mean, what does that pitch sound like? Because I feel like the knee-jerk reaction for a lot of folks might be, there's a lot going on in that part of the world.
Yeah, so the investment thesis for Israeli ETFs in general, and iTech in specific, has been, as Eric noted, you don't have these companies in your portfolio. Even though people have been overweight tech, they haven't had this tech. So you have to make an intentional decision to allocate. The beautiful thing about it is that EFA and developed markets are quite underweight tech. So this ETF can help you bolster tech in developed markets and give you exposure to a country that's a relatively low weight in developed markets.
I'm just looking at the allocation here for iTech, and 20% of the fund is software companies. What is the impact of the whole AI scare, this idea that AI is going to displace software companies? What does that mean for Israeli tech companies, Israeli software companies?
So the Israeli SaaS companies have been hurt. Companies like Wix and Fiverr have been hurt, but others that are very engaged in AI and semiconductor, like Tower Semiconductor, as well as cybersecurity, have done well. In fact, CyberArk was just acquired by Palo Alto Network, its largest acquisition ever.
I've known you for a long time. This guy is a veteran. He's been in the ETF industry really since the first days. You wrote a book. What's it like being on the issuer side with this sort of, I consider you indie, trying to go out there and sell an ETF? What have you learned?
So you are aging me, but my gray hair matches you. I'm happy to take it. And I remember when ETF launches were on the Amex floor. That's how long we go back. But we launched this as an indie, as Blue Star. But then, just to be clear, Blue Star, we sold the index part of the business to MarketVector. So I now head MarketVector. But it's hard. You're fighting for shelf space. You're not in the model portfolio. So why is EIS so much bigger than ISRA? Because BlackRock's got it in its models. What we have done with iTech has been connect with the affinity groups, people who care about Israel, who are interested in Israel. This includes American Jews, pro-Israel Christians, but also tech nerds, people who really understand. Israel punches so far above its weight in tech that people in the tech community understand it. It has the greatest number of startups, not per capita, but in absolute term than the United States. So people who know tech, they want to have exposure. And these are the tech startups that have grown up. Israel used to be called Startup Nation. It still is by many people. But people who know now call it Scale Up Nation. And those scaled up companies are in iTech.
All right, Stephen, got to leave it there. Great to get some time with you. That is Stephen Schoenfeld of MarketVector Indexes. And you can read all about this drill down, plus the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. There's Bloomberg.com/ETF IQ newsletter. It comes out on Fridays. Please subscribe.
Coming up on ETF IQ, it is time for an IQ test where Joel Weber puts our ETF knowledge to the test. This is a sneak peek at one of the questions. Which ETF has the highest total cost?
Ooh.
HDGE, DVDN,
I actually know this one.
PVDC, ORR. You know this one.
I do. I won't tell you.
This is ETF IQ. I'm Bloomberg.
This is Bloomberg ETF IQ. I'm Katie Greifeld along with Scarlett Fu and Eric Balchunas. And it's that time of the show. It's time for an IQ test where Bloomberg's Joel Weber is going to see whether Scarlett, Eric, and I really know our stuff when it comes to ETFs. You know Joel as the co-host of the Trillions podcast with Eric, and he's also the head of games at Bloomberg, the first to ever hold the title. Joel.
Are you ready?
I don't know.
Have you been doing your homework?
Kind of.
Okay, well, we'll
Just
find
like
out.
How do you even prepare for this test?
You know, there's things you can do. You can read a lot of research and get on your Bloomberg terminal and do some filtering. Okay, this is a big week for space stuff.
Yeah.
We might be going towards the moon again. Which of these space-themed ETFs has the highest 5-year returns? Is it A, UFO, B, Rocked, C, Mars, or D, ARCX?
I'm going to go with C or D.
Okay.
You have to pick one, though.
Okay, D.
It's a nice try, though.
You're going with D?
Yeah.
Okay, I'm going with D, too, because I think that defense,
Yes.
I know that
Okay.
defense has done well.
Okay. Eric?
I'm going to go with B because I think, and that one's been around a while. I think the other two are not 5 years old.
He saw through it. C and D haven't been around for 5 years, so
I'm going to roll,
Eric gets
roll out
round
of here.
one. That is
I feel like it's a
B.
technical win.
Yeah,
Yeah, I don't like that.
It was sleuthy. Good
Scarlett
job,
and I
Eric.
are booing.
Way to see through it. Okay, round two. Our question is really about whether or not Eric's been doing his homework and reading his own research. Nearly 90 ETFs launched in February. According to Bloomberg Intelligence, about 88% of them shared what trait? A, they were actively managed. B, they held NVIDIA. C, they came from indie issuers. That's like one of Eric's favorite words.
Right.
Or D, they were thematic.
Ooh, this is good.
I'm going to go with A, actively managed.
I'm going to stick with Scarlett. I'm going with A, too.
I didn't
Either
know you
way.
anymore.
I'm with her.
We were due for a layup. It's easy.
It is A.
Oh, thank
All right.
God.
All right.
Yeah.
Way to
Yay.
bring it
Good job,
home.
everybody.
Okay.
We like that question.
Final question for today and this round. We had a sneak peek of it before. Which of these ETFs has the highest total cost? It is also the highest total cost, I think, in all of ETF-dom.
Oh, my God. I
Yeah.
mean, gosh.
And
Eric, what were
I
you
did
saying
this.
before?
You can go to expense ratio on ETF Go, and that's how I filtered for
Expense
it.
ratio includes acquired fund fees. Hint,
Yep.
hint.
Hint,
I
hint,
know.
hint.
I'm so psyched.
Okay. Scarlett, what do you think?
I'm going to go with A.
She's just like, these are tickers. We read them out before, but hedge, HDGE, dividend, DVDN, PBDC, or ORR.
It's C.
She says that with confidence.
I think it is C because the acquired fund fees.
Okay, reveal.
Oh,
my gosh.
She's so confident, though.
Honestly, I've never even heard of that fund.
There you go.
What is it doing?
Yeah,
God.
well, we can go figure it out, but, you know.
No one's happy.
2 out of 3 for Eric. I think 1 out of 3?
Yeah.
Okay, all right, well, better luck next
We
time.
got to
We're
have
zeroed out.
this person on.
If-
Like, why are you
There
charging
go.
so much?
We'll find out.
Okay.
Okay, well, if you like this, you can play more quizzes at QuizGo on the terminal or go to bloomberg.com/pointed where we let you do a news quiz that has some leverages.
Yeah.
Have some fun.
It
2x,
hurts.
3x, or even hedge if you need to.
Hurts even more. Our thanks to Bloomberg's Joel Weber. That does it for ETF IQ, the TV show. This is Katie, along with Scarlett and Eric. This is Bloomberg.